How is an accumulation trust taxed? Have you ever wondered how an accumulation trust is taxed? Understanding this can be key for effective estate planning. Let's break it down in simple terms. An accumulation trust is unique because it keeps the income it generates instead of giving it right away to beneficiaries. This means that the income earned by the trust is taxed at the trust level. Trust tax rates are different from individual tax rates. In fact, they can reach the highest rates at much lower income levels. This can lead to the trust paying more in taxes on the income it retains than if the income were distributed to beneficiaries, who might be taxed at lower rates. Now, if the accumulation trust is funded with retirement accounts, such as individual retirement accounts, there are additional rules to consider. The Internal Revenue Service requires that required minimum distributions be taken from these accounts. This is true even if the income is reinvested within the trust. The income generated from these reinvested distributions is also taxed at the trust level. The schedule for these distributions is usually based on the life expectancy of the oldest beneficiary, which can shorten the distribution period compared to individual beneficiaries. When the trust finally distributes the accumulated income to beneficiaries, those amounts are taxed as income in the year they receive it. This can actually be a smart way to plan taxes. By timing the distributions to beneficiaries in years when their tax rates are lower, you can help minimize their tax burden. Another important aspect to think about is estate and transfer taxes. Accumulation trusts can help preserve and grow assets for future distribution. This can protect the assets from creditors and help manage how beneficiaries handle their finances. Keeping income within the trust can also reduce the size of a beneficiary's estate, which might lower estate taxes when they pass away. In practical terms, an accumulation trust is beneficial when the person creating the trust wants to control how and when beneficiaries receive their distributions. This is especially helpful if the beneficiaries are minors, have special needs, or may not be financially responsible. The trustee has to find a balance between allowing the assets to grow and managing the higher tax rates on the income that is kept in the trust. Overall, an accumulation trust pays income tax on the earnings it retains at the trust tax rates, which are often higher than individual rates. When income is eventually distributed to beneficiaries, it is taxed at their individual rates. If the trust is funded with retirement accounts, required minimum distributions must be taken, and any income from those distributions is taxed within the trust. Using accumulation trusts wisely in estate planning can help grow assets, protect beneficiaries, and manage tax liabilities, but it requires careful planning to navigate the tax rules effectively.